What's going on, everybody, and welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade and invest in the stock market for yourself. Make sure you please subscribe. Make sure you hit that notification bell so you can be in the know every single time that I drop an episode. Please note, anything that I discuss in this episode is not financial advice. So please do your own research before investing into any stock. In this episode, we're going to talk about the worst performing stock in the first quarter of 2024 in the S&P 500. If you can take a wild guess on what that stock is, that is Tesla, ticker symbol TSLA. The stock was down more than 29% in Q1, making it the third worst quarter for the company. Went public in 2010. Okay, this company has been dealing with a lot of negative sentiment around this particular company, and I'm here to make an argument as a Tesla shareholder, as a Tesla bull, as a Tesla long-term believer. This is probably one of the best buying opportunities that we have ever had for this particular company. I'm going to take a lot of time to break everything down and really give you all the information to let you all know this is the time that you need to be considering buying this stock. Let's get into it. Okay, everybody. So let's start this episode off with the negativity. I want to really go over the negative news because I will acknowledge that I am a Tesla shareholder, and I will acknowledge that I am long-term bullish on this stock. But I don't want people that listen to this episode or listen to this podcast to think that I just have rose-colored glasses on. So I want to give you all the negativity, really break everything down, and attempt to put everything into context. So Tesla shares fall after deliveries drop 8.5% from a year ago. So Tesla reported deliveries of 386,000 vehicles, a drop of 8.5% from the same quarter last year. And according to a mean of 11 estimates, analysts were expecting deliveries of around 457,000 for the first quarter of this year. And this was Tesla's first year-over-year decline in deliveries since 2020, when its operations were disrupted by the global pandemic. Now this is a huge deal. Okay, this is a huge deal because the last time Tesla experienced this was in 2020. And in 2020, the world was shut down. And so when you think about it from that perspective, this is definitely not a good thing. And this is just one of the things that has attributed to Tesla having the third worst quarter that it has had since the company has went public. So let's look a little bit more deeper into these numbers. So in Q1 deliveries, the company again had 386,810 vehicles, and the production was 433,371. So the vehicle production declined around 1.7% and 12.5% sequentially, not nearly as steeply as the 8.5% annual drop in deliveries. And so that's kind of the negative thing as well, because that's kind of showing that demand may be waning, because the production is higher, but the deliveries is not as close to the production. We would like to see the deliveries and the production a little bit closer. And so that is one thing that is definitely a negative situation that we cannot sneeze at. If we look at something else, Tesla does not break out the sales by model, but it reported that it produced 412,376 Model 3/Model Y cars, and it delivered 369,000 of them, and it produced 20,995 Model 1000 of its other vehicles and delivered 17,027. In the same period last year, the company reported 422,875 deliveries and production of 440,808 vehicles. So the deliveries and the production was a little bit closer in line, which tells me, right, that the demand was much more closer. Now, the deliveries are the closest approximation of sales reported by Tesla, but are not precisely defined in the company's shareholder communications. Now, this is one thing that everybody always talks about. Everybody is always looking for Tesla's delivery numbers within the first 3 days, whenever the next quarter drops. And so this is a huge thing, right? This is a huge thing, and we need to take this into consideration when we're really truly talking about this particular company. Now, this is another article that I want to highlight, and this article does a really good job of explaining the reasons why Tesla is dealing with what the company is dealing with. So Tesla's awful quarter has Wall Street on edge of delivery numbers. Now, Tesla shares plunged 29% in the first quarter, the worst period for the stock since the end of 2022, and the third steepest quarterly drop on record. Investors are concerned about auto sales as the company faces increased competition from China and disruptions in Europe. And according to data from S3 Partners, Tesla shorts are up more than 5.77 billion in 2024, making it the most profitable name in the United States. So there are a lot of hedge funds out there that are betting against Tesla stock, and they are making a whole lot of money from it. Now, the chief concerns among Tesla on Wall Street is in Tesla's core business. And so let's go through and let's break down the main reasons why Wall Street is really having a hard time dealing with this particular company. So the first reason they have listed is the unrelenting competition in China. In China, there's competition from an onslaught of fully electric vehicles, including new models that cost less than Tesla's popular Model Y SUV and Model 3 sedan. To end 2023, China's BYD dethroned Tesla as the world's top EV maker. In the first quarter of this year, BYD kept up the pressure, launching its Qing Plus EV at a starting price of around $15,200, followed by BYD Seagull, a small electric hatchback with a starting price below $10,000. Now, this particular sentence right here, to end 2023, China's BYD dethroned Tesla as the world's top EV maker. We are going to come back to this in another article because this is just not true. But we're going to talk about that later. Let's continue on the negativity around Tesla. Okay, so the one thing that we need to understand, another thing that was negative around Tesla is the Red Sea attacks and the activist clashes in Europe. Now, there was also drama in Europe, and Tesla and other manufacturers like Volvo suspended some production on the continent in January due to a shortage of components following attacks on shippers in the Red Sea. Now, Iran-backed Houthi militia attacks have continued to disrupt one of the world's busiest routes. Then in March came a dramatic protest by environmentalists in Germany, objecting to Tesla's plans to expand the footprint of its car and battery factory in Brandenburg outside of Berlin. The protesters set fire to electrical infrastructure near the Tesla plant. While the fire didn't spread to the factory, it left the facility without sufficient power for operations, forcing a temporary suspension in production. And CEO Elon Musk visited the Germany factory after the attack to reassure employees. He called the protest extremely dumb. Tesla's head of policy, Rohan Patel, wrote on X that Tesla's mission is to create zero emissions products. But to do that well, we also focus on creating the most sustainable factories along with a culture to do the right thing in our community. Now, the one thing that we need to understand is that I remember during the last quarter, the stock price dropped like 5 or 6% on this particular news. So this actually was a big deal in terms of the negative performance that the company has dealt with. Meanwhile, in Nordic countries, Tesla service technicians and other workers have been on strike in support of the Swedish labor union IF Metall. The labor group has been pressuring Tesla since October 2023 to negotiate and sign a collective bargaining agreement with its workers. IF Metall's website says that 9 out of 10 workers are union members in Sweden, yet Tesla has resisted unions, as it consistently does in the United States, and rebuffed IF Metall's efforts to negotiate. So this is a pretty big issue that the company has dealt with. Like I told you all before, I remember the stock price dropping between 5 to 6% on this particular news. So this is just another thing that the company is just dealing with in terms of the negative sentiment. Another issue that the company is dealing with in this article is describing the aging lineup in the early days for the Cybertruck. Now, while EV sales are still gaining popularity worldwide, the growth rate has slowed. And with Tesla no longer the dominant player, this is not true, guys. Every new product becomes more crucial. There's not a lot in the hopper. The Cybertruck is still in its very early days and has a niche audience. The company began delivering the angular, unpainted steel model of the truck in December at a promotional event in Austin, Texas. Musk previously stated on an earnings call that Tesla dug its own grave with the sci-fi inspired Cybertruck. In an interview with a Tesla fan and auto critic Sandy Munro in late 2023, Musk cautioned that the Cybertruck is not something that will be material to Tesla's financials in 2024 and will probably be material in 2025. Tesla has been gearing up production for its refreshed Model 3, known as the Highland in Fremont, California. Forbes' Larry Magid wrote, "Visually, the changes on the outside are subtle." He also disliked Tesla's controversial design decision to omit stalks from sides of the steering wheel. Highland drivers use buttons and on-screen controls to shift between drive, reverse, and park, or to signal a turn or lane change. And Tesla does have a totally new platform in the works, a more affordable EV that fans refer to as the Model 2, but it won't be delivered to customers for years. So this is an issue. It's an issue when a growing company is trying to understand how it needs to scale, how it needs to innovate, how it needs to roll out these additional products. And whenever you roll out these additional products and you're trying to create these vehicles, and you're creating fully electric vehicles, mind you, it's going to take time to get everything where you need everything to get to. And so I understand this particular concern, but if you have a long-term viewpoint of the company, this is not something that we're not really going to be dinging Tesla that negatively on this particular situation. Another thing that we need to pay attention to is the Musk control and controversy. Now, Musk has continued to bet that Tesla customers and shareholders will stick with the company regardless of his increasingly incendiary rhetoric on X and beyond. Earlier this month, Musk met with former President Donald Trump in Florida. He's called for a red wave in upcoming U.S. elections, and he shared, liked, or otherwise promoted far-right accounts and content on X, where he now has 178.8 million listed followers. He has repeatedly disparaged undocumented immigrants, ranted against corporate diversity initiatives, and made absurd claims that migrants from Haiti are cannibals. Also, Musk's political ideology stands at odds with groups of people most likely to buy his products. Proponents of electric vehicles tend to be left-leaning ideology, according to research from Pew Research and Gallup last year. Musk has also wagered that Tesla shareholders and its board of directors will follow his lead. In February, Musk said he would move for a shareholder vote to transfer Tesla's site of incorporation to Texas from Delaware after a judge in Delaware voided the $56 billion pay package that he was granted in 2019 on grounds that the board failed to prove the compensation plan was fair. Before the ruling, Musk had begun pressuring shareholders and the Tesla board to give him more control of the EV maker. Musk said that I am uncomfortable growing Tesla to be a leader in AI and robotics without having 25% voting control. Investor Ross Gerber, a longtime Tesla bull, called the demand tantamount to blackmail in an interview with CNBC. Now all of this can be seen as largely negative, and some of this stuff is disturbing, to be quite honest with you. But Elon, he does these things. He does these crazy things, and he has to be this figure. And he's always going to be somebody that's going to worry investors and worry shareholders with the antics that he makes on social media and the things that he says. I think that this is just, largely something that we can put behind us, and it's something that we will be able to put behind us. But nevertheless, it is not a good thing that we are continuing to see all this negativity and Elon is continuing to run his mouth unnecessarily. Now, the last thing we see on the article, they say that bears have been cleaning up, and it also adds up to over $230 billion in lost market cap for Tesla and its shareholders since the calendar turned to 2024. That made for a very lucrative quarter for short sellers who've been expecting such a downturn. According to data from S3 Partners, Tesla shorts are up more than $5.77 billion in 2024, making it the most profitable name in the U.S. short interest. At the end of the trading on Thursday was about 3.76% of the float, representing 18.71 billion in notional value. Altamar Capital Brad Gerstner is buying the dip. Gerstner told CNBC that this week that the company is now making massive progress at an accelerating rate on self-driving vehicle efforts. Musk has been making such pronouncements for years. In 2015, he told shareholders that by 2018, Tesla's cars would achieve full autonomy and be able to drive themselves. In 2016, he said Tesla will be able to send one of its cars on a cross-country drive without requiring any human intervention by the end of the following year. Tesla still has yet to deliver a robo-taxi, autonomous vehicle, or technology that can make its cars into level 3 automated vehicles. However, Tesla offers advanced driver assistance systems, including a standard autopilot option or premium full self-driving option, the latter of which costs $199 a month for subscribers in the US or $12,000 up front. In a push for end-of-quarter sales, Musk recently mandated that all sales and service staff install and demo FSD for customers before they hand over their cars. He wrote in an email to employees, almost no one actually realizes how well FSD actually works. I know this will slow down the delivery process, but it is nonetheless a hard requirement. Despite its name, Tesla's premium option requires a human driver at the wheel, ready to steer or brake at any moment. Now, when we look at how much money has been made to the downside on this company, I'm not mad, because at the end of the day, in the stock market, bulls make money, bears make money, pigs get slaughtered. And so I'm not mad that all the short sellers are making money, because when we look at the charts, we're going to see what Tesla has been doing, and we're going to see that this stock is in a downtrend. But I do like how we see that there are certain investors out there that are buying this dip. They're buying this dip because they understand that this is a buying opportunity for a company that is set to do some amazing things over the long term. Now, we have talked a lot about how Tesla has been doing negatively and the negative sentiment, but let's shift the focus a little bit and let's provide a little bit of context about what's actually going on with the entire market. Now, this article is talking about the Asia market's fall as shares of electric vehicle makers are in focus. Asia Pacific stocks declined Wednesday after a mixed session, with markets watching for moves in electric vehicle makers. Now they're talking about Tesla, where Tesla's first quarter vehicle deliveries dropped 8.5% from a year ago, sending shares of the US EV maker down 5%. Chinese EV maker BYD said that its first quarter sales plunged 43% quarter over quarter. The number one competitor to Tesla, their shares, their sales plummeted 43% quarter over quarter. BYD shares fell 1.5%, while Hong Kong's index opened 0.5% lower after rising no more than 2% the previous session. Other EV makers also fell, including NIO down 2.5%, Li Auto down 1.5%. Investors are also monitoring data on China's service sector. Now, what this tells me is that Tesla is not the only company in the world that is dealing with the slowing EV demand. The EV demand is just going through a period. We're going through a period and we're going through a process to where the demand is just slow right now. Okay. When you see a company, the number one competitor that they want to say, which is BYD, when you see their sales down 43% quarter over quarter, that tells you that they've got some things going on. There may not necessarily be something wrong fundamentally with the company. They may just be dealing with some negativity in this particular area of the market. And so we need to pay attention to that, and we just need to put that into context as we talk about what's going on throughout the entire EV market. Now, I told you all that we were going to talk about BYD and we were going to come back to what they were talking about in a couple of previous articles that I was highlighting. Now, this article says that BYD beats Tesla for a second straight year after producing more than 3 million cars in 2023, right? Now, the one thing that it says is that BYD said that Monday it produced more than 3 million new energy vehicles in 2023, putting the Chinese electric car giant on track to surpass Tesla's production for a second straight year. Now, here's the thing that we need to pay attention to, okay? So, Tesla said that they produced 1.84 million cars in 2023, right? Now, Tesla produces fully electric vehicles, battery operated. They do not produce hybrid vehicles at all. Now, BYD, they manufactured 3 million vehicles, but they only manufactured 1.6 million battery-only passenger cars, and they had 1.4 million hybrids, which makes up the 3 million. And that puts Tesla on top for the battery-only production. So what we have to put into perspective is that BYD is not the number one EV maker. They are not. Tesla is the number one EV maker, because we cannot count hybrids in that, because hybrids are not a purebred, fully electric battery operated vehicle. So I have issues when they put out certain articles about BYD and the competition and all these different things, when it's just incorrect. They're not putting this into perspective in terms of what's actually going on in the marketplace, right? The quality, how long Tesla has been doing this. We're talking about this company went public in 2010, and there are articles being written saying that Tesla is no longer the big dog, that Tesla is no longer the number one player. That is incorrect. They are the number one player. They remain the number one player. Even in the first quarter, Tesla delivered more vehicles than what they did. And so we really need to pay attention to this and put this into context. Please read deeply into these things. Don't just take these things at face value. Really truly understand what these companies are actually doing and put that into context and say, okay, has Tesla really been surpassed? No, Tesla has not been surpassed. Okay. And hey, even if Tesla does get surpassed, Who's going to make more money from their cars? Who's going to have the best ecosystem? Who has the best technology? That's what we need to be paying attention to when we're talking about these companies and the competition. Last thing I'm going to say about the competition. Competition is what makes a market, everybody. Competition is what makes a market. If you tell me that a company shouldn't be invested into because of competition, competition is just a very, very poor argument, because every industry across the entire world deals with competition. Every single industry deals with it. So the difference is, what are you going to do to be able to navigate the competition? What is your moat? What type of value are you going to be able to provide in spite of that? Because it's not just the price. It's not just the price that's going to determine how many cars you're going to sell or the particular product you sell. It's the value that you provide. That's what's really going to be able to give you that edge against other competitors in your respective market or markets. Okay, so I'm pretty much done going through the negatives on Tesla in terms of the sentiment, the negative sentiment around Wall Street, and all of the fundamental reasons in terms of why this company has been doing what it's doing. But I want to look at this outlook right here, because this is very, very important. So I'm going to go through some information from the 2023 Q4 quarterly update. We need to go back to this and really revisit this, to really put some things into context. So for the outlook, Tesla said this. They said, our company is currently between two major growth waves. The first one began with the global expansion of the Model 3/Model Y platform, and the next one we believe will be initiated by the global expansion of the next generation vehicle platform. In 2024, our vehicle volume growth rate may be notably lower than the growth rate achieved in 2023, as our teams work on the launch of the next generation vehicle at Gigafactory, Texas. Now I'm going to say this one more time. In 2024, our vehicle volume growth rate may be notably lower than the growth rate achieved in 2023, as our teams work on the launch of the next generation vehicle at Gigafactory, Texas. In 2024, the growth rate of deployments and revenue in our energy storage business should outpace the automotive business. Now, the company already told us this, y'all. In January, they told us this. Now, mind you, me personally, I didn't think it was going to be this bad. I'm going to be honest with you. My hands are up. My hands are tied behind my back. It is what it is. I understand that we didn't expect it to be this bad, but they did tell us that it was going to be notably lower. They told us this. So I'm not really surprised necessarily. I'm not really surprised about it. You know what I mean? I understand that we may be shocked at the level that we're talking about, but they told us that it was going to be notably lower. And if we look at the deliveries that we had in Q1, they were most certainly notably lower. So when I look at this, me personally, I like to listen to the company. I like to listen to the calls and just see what the company is saying. You know, because the company is going to tell me what's actually going on. The company knows what's going on. And if I listen to this company quarter after quarter after quarter, and they give me this information, I can take this information and say, okay, this is my expectation. I understand that Wall Street may not be pricing this in, but I do understand that this is an expectation. And this is something that we need to pay attention to nevertheless. Now, everybody, we understand that Tesla is still the #1 player in electric vehicles, but the technology that is incorporated within those vehicles is the bull case that I have for this particular company, autonomous driving. So let's talk a little bit about what they said about autonomous driving. In Q4, we released our latest FSD beta software version 12 to Tesla employees and more recently to customers. Version 12 utilizes end-to-end training, enhancing the driving experience. We also introduced the second generation of the Optimus robot, which uses Tesla designed actuators and sensors and improved AI capabilities. Both FSD Beta and Optimus are trained with similar technology pillars, real-world data, neural net training, and cutting-edge hardware and software. So let's talk about FSD first. Let's focus on that FSD first. Now, this is the chart showing the cumulative miles driven with FSD Beta. Now, in March of 21, we see this was down here around zero. And it was slowly creeping up, not really moving much, but this is exponentially moving higher. And by December 23, we're talking about over 700 million miles, nearly 800 million miles of FSD Beta. What we have to understand is that this company is on an exponential trajectory in terms of the amount of data that is able to accumulate. The more data that the company is able to accumulate, the more trained that the FSD will be able to have. That's what it's talking about. We're talking about neural net training. The more miles and the more data that this company is able to receive is going to make the FSD software even more better. Because I'm telling you, autonomous driving is going to happen. Okay, it's gonna happen. Whether you like it or not, whether you believe it or not, whether you're listening to certain news outlets and things of that nature, autonomous driving is happening. You know why? Whenever I look on LinkedIn, I'm seeing a whole lot of NVIDIA. I'm seeing NVIDIA talking about how they're using their GPUs and their NVIDIA Drive software for autonomous driving. When I looked on LinkedIn, I look at Waymo, who is a subsidiary of Alphabet, talking about how they are rolling out autonomous driving in California, in Phoenix, Arizona, in other places in the United States. We have heard Microsoft talk about GM Cruise and their subsidiary and what they're doing with their technology. When I hear the trillion-dollar companies in this marketplace talk about FSD, and not even FSD, because FSD is truly Tesla. I'm just talking about autonomous driving. When I hear them talk about autonomous driving, that makes me more bullish on Tesla, because I think that people forgot who the originator really was. And so really keep that into perspective now when we talk about what autonomous driving is and what autonomous driving will be in the future and what this can add in terms of value to the company. Second thing, autonomous robot, the robotics and everything that is going on, right? In terms of manufacturing and also in retail. We saw that NVIDIA and Amazon and other companies are partnering together on a project dealing with a robot in the same way Tesla is doing. That just makes me more bullish because Tesla is really the one who is driving this AI edge. This company, Tesla, is an AI company that just happens to produce electric vehicles. Now, again, Tesla's been dealing with a lot of negative sentiment, but this is the one thing that makes me very, very bullish as a shareholder of this company, and it's the balance sheet. Now, there's a few things I want to focus on with this particular balance sheet. The first thing is the assets, and it's the current assets. Now, this company, now mind you, for context, this was released in January, so we haven't seen the Q1 2024 numbers yet. This is just what we know as of January, but I'm willing to argue with you that the balance sheet hasn't changed that much in 3 months for this company. I'm just going to argue that, and that's going to be my argument for what I'm about to say. The cash and the cash equivalents is $29 billion in cash that this company has. Year over year, the company increased the cash and the cash equivalents. We're talking about almost 7 billion in increase, which is a huge deal. The total current assets is 49 billion, which is great. The total current liability is 28 billion, which is great. What do we mean in the difference between current assets and current liabilities? Current assets is the money or the assets that the company is expected to generate within that given 12-month period. The total liabilities is the money and the resources that's expected to go out of the company within that 12-month period. We are well above where we need to be in terms of making sure that current assets are above our current liabilities. Also, our debt. Where is the debt at? The debt, we're talking about $2.8 billion in debt and $29 billion in cash. The great Peter Lynch once said that it is very hard for a company to go out of business when it has a low amount of debt. Tesla could wipe this debt out tomorrow if they wanted to. Total assets, 106 billion. Total liabilities, 43 billion. So they have more than twice the amount of total assets than they have in total liabilities. This makes me feel amazing when I consider myself a shareholder. When I'm thinking about buying more shares of this company as the company is going down, because I understand that the company is doing well from a financial perspective, and that is what's going to help the company fund all of the initiative that it's trying to build and is trying to accomplish. Now, I know that you're probably getting a little antsy. You probably want me to get into the charts. I know you want me to get into the charts. But this is the last thing I need to go over. And this is valuation. And valuation is what we look at when we say, what is a company is worth? Now, we can look at the valuation and we can really look into the numbers and things of that nature. And that's good for us to do. But I think what's more valuable is looking at valuation for companies in relation to how it has been normally valued and traded over the last 5 years, right? Because, I'm a technology guy, I'm a technology bull, I'm a technology investor. And technology is always going to be more expensive on a valuation perspective. It's always going to be more expensive. It just happens. But I think what will be more valuable is saying, okay, how is this company valued right now in relation to how it's normally valued over the last 5 years? That will give me a good breadth of data to really be able to break down what's going on. So there's 3 metrics, there's 3 valuation multiples I want to check out. The price of sales, the enterprise value to sales, and the price of book and the price to book. The price of book is the forward 12-month value. The EV to sales is the trailing 12 months. So this is the last 12 months. The price of sales, that's the forward 12 months. So currently Tesla is trading at a 4.89 price to sales. That is below the 5-year median, the 6.88. So Tesla is undervalued in relation to its 5-year median price to sales trading metric. Enterprise value to sales, Tesla is currently at 5.55. With 5.55, the 5-year median is 8.51. So Tesla is trading undervalued in relation to the 5-year median of this metric. And price to book, Tesla is 8.94, but the 5-year median is 17. So Tesla is trading undervalued in relation to the 5-year median price to book price. So what we need to understand is that this company is undervalued from every metric. We know the company is dealing with a lot of negativity and a lot of sentiment, but nevertheless, the company is still undervalued. What did Warren Buffett teach us? Warren Buffett taught us that you have to be greedy when others are fearful, and you be fearful when others are greedy. This is really the opportunity to really go out here and build you a position in this stock. All right, so if you've made it this far, you have finally made it to the chart section. Now, if you are on the YouTube and you are looking at the charts, I have a 5-year weekly chart of Tesla stock. And as you can see, Tesla stock has been all over the place over the last 5 years. This stock was as low as $11.80 back in 2019, and the stock got as high as $414.50 back in November of 2021. Now, again, the stock has been all over the place, but the stock has not even sniffed this $414.50 price that it had back in late 2021. So let's go a little bit. So let's go down and let's go ahead and go to the daily, shall we? All right. So this is the 2-year daily chart. And so when we look at what's been going on the daily, right over the last 2 years, the stock was as high as $384.29. But the stock got as low as $101.81. That was back in January 2023, right when we were in that bear market, right when we were really in the midst of that bear market. And there was a lot of negativity around the market. It wasn't just Tesla. It was really every stock, essentially, well, that was going down, except for energy. So when we look at what's going on, the stock is at $166.63. Now, the stock was down 4.9% today after the results of their deliveries. And so when you look at this chart, you're going to look at this and you're going to say, man, Devon, this is just negative, man. This is negative. If I look at the trend line I just put up here right here, this is a downtrend, right? This is a downtrend. So why are you suggesting that I buy this stock on this downtrend? Here's the thing, and here's my argument. I'm not making the argument that you're going to buy Tesla tomorrow and you're going to catch the bottom and Tesla's just not going to get that low anymore. My argument is that time in the market is better than timing the market. So in order to really build wealth, in order to really build meaningful positions in stocks, you have to buy shares over time. You have to hold them over time. My argument is that you shouldn't try to time this stock if you're trying to hold it for the next 5 years. You should be focused on finding good entries and finding good prices and building positions, because we can't time the market. We have to be committed to putting our time into the market, understanding that time in the market is better than timing the market. So if you believe in the stock, go ahead and grab you some shares. If the stock is still at 166.63 in the morning, grab you some shares. If it goes lower, buy more. Build you a position while the stock is dealing with all this negativity. That way, when we come out of the negativity, you will be in a very, very advantageous position. Now, I want to pull up the Fibonacci levels, because the Fibonacci levels are very, very important. And so to explain what Fibonacci levels are, Fibonacci retracement levels, they provide us certain levels and certain potential discounts based on certain prices that stocks have been. And so when you draw your Fibonacci levels, you want to draw your levels from a high down to a low. So pretty much a level that you deem a high down to a level that you deem the low. So I'm going to deem 101.81 the low. I don't see the stock getting below this. This is the low. This is the lowest that this stock, I believe, can go. 299.29. That's the 52-week high. That is the highest that the stock has been over the last 52 week of the last 52 weeks. So that's what we're going to deem the high. A 50% retracement, that is signifying essentially, half off based on this particular metric. But if we look at it, we're below the 38.2% Fibonacci retracement level, and we're hovering, we may actually get down to this 23.6% Fibonacci retracement level. Now, if we get below this level right here, this is going to cause for some serious concern for the stock. I'm not even going to lie to you. We're going to be having some serious concerns if we get below this 23.6% level. But I believe that it's possible because of the trading and how all of this looks from a trading perspective. So I'm gonna look a little bit closer here. Let's look a little bit closer. So Tesla, back in 2023, Tesla gapped up. Tesla gapped up in January of 2023, and it never closed this gap. And this gap right here is a level of about $146.41 roughly. And this gap has never been filled. This gap has never been filled since it's gapped up. The lowest that it came down was $152.37. Now, we could say that, hey, the stock may come down here. It may sniff here or whatever, and it may go back up, and we may never fill this gap. But essentially, a lot of times gaps tend to get filled. So this particular Fibonacci retracement level actually coincides pretty closely to this gap. So from a trading perspective and just looking at it, this tells me that we could get to this particular level. But again, if you believe in this company over the long term, I don't want you waiting to this level and buying all these shares at the particular level. You could do that. It's a possibility, and it will be a great trade. But focus on building the position. Buy you a little bit. We're at the point, we're really truly at the point to where you can really truly establish you a starter position right now. We're at that point because we are so negative. The stock is just so downtrodden. It's just so much negativity going on to where this is a real deal buying opportunity for Tesla stock. At the end of the day, the market cap for this company has been cut in half. This company was once a $1.2 trillion company. Now it's around $550 billion. This company is dealing with EV winter. This company, the electric vehicles are down 8.5% year over year. The first time that has happened since 2020. And that was in the middle of the pandemic when nobody was even moving around. This company just had the third worst quarter it's ever had as a publicly traded company. And we believe that Tesla was a mature company. But at the end of the day, Warren Buffett said something very specific. He said, you've got to be fearful when others are greedy, and you've got to be greedy when others are fearful. If you believe in Tesla as a long-term position, if you believe that this is a company that's actually going to grow revenue, grow profitability, this is a company that's going to just take over and continue to be the leader in the EV market, and also take advantage of the technology and AI with autonomous driving, AI with the autonomous robot and things of that nature. If you believe that, this is the time that you need to buy as much of this stock as you can, because I'm doing it with you guys. As always, I appreciate you all for tapping into another episode of the Trade for Yourself podcast. Please like, please subscribe. Make sure you hit that notification bell again so you can have the information as soon as it comes out. please reach out to me in the comments. Let me know if you're going to be buying Tesla stock. Let me know if you believe in this company as a long-term investment. Let me know if you want this company to help build wealth for you and your portfolio. As always, remember, don't pay for it. Trade for it. I'm going to tap in with y'all in the next episode.